My client lost over $1 million at age 40, which is almost 2/3 of his net worth. Why? Because he didn't listen. The adage I like to use is consolidated stock positions create wealth, or can create wealth. Diversification maintains it. Too often we get lucky or buy good companies cheap and they have big run-ups in value. Today, a lot of the companies in the S&P 500 or the NASDAQ are richly valued. They're selling for many multiples of their earnings. It's easy to get married to these stocks, or maybe you work for the company and you get stock options, and over time your portfolio becomes concentrated in one or two positions. And maybe because you work for the company, you think you know what's going on better than the average investor, or you've just seen it go up so much it's impossible, you think, for it to come down that much, but it is possible. There are a lot of factors out there beyond our control, but what we can control is what we own and how much of it, which dictates our risk. I like to put risk first and returns second. If I get the risk right in my portfolio, the returns I want should come. They may not come in the time I want them to come, but over time, I should get the returns that we need, unless the world collapses, and then it's not gonna matter anyway. So if you have a concentrated stock position, there are a lot of different ways you can go about mitigating that risk. Maybe you are an executive at a publicly traded corporation. Hopefully you are aware of a 10b5-1 trading program, which lets you pre-establish exit dates and sell based on pre-authorized execution lists to mitigate those positions over time. Or just consider creating a sell discipline. It's really hard for anyone to create a sell discipline because we think stocks are going to go up forever and we don't want to sell. And sometimes it's better not to sell. But again, look at your total portfolio, look at the weight of that stock or that position or that ETF or that allocation as your total percent of the portfolio, and figure out if that's right for you. In the case of this example, he was a brand new client. I got him to sell a little bit of stock. We got him to write covered calls on that stock, which means as it goes up, he gets paid a little bit and sells some stock. So we sold maybe 20% of it, but he was still overly allocated. I couldn't get him to sell more than that, and the stock went from $120 a share to 20. I think now it's trading in 14s or 15s. Now at 14 or 15, it's probably a really good buy, but it would be really nice to carve off some of those gains and have some capital to buy it again now. There's a lot of ways to hedge portfolios. If you want hedging strategies, look me up, give me a call. We can talk about those as well, or go online, do your research. Again, we could talk about hedging strategies to try to mitigate some of those risks if you do have a concentrated portfolio or you're worried about a market correction. Hedging strategies always have risks and rewards. The risk is maybe you don't make as much when the markets go up or you get the timing wrong. The reward is maybe you don't lose as much. Not how much you make or earn, it's how much you keep. The moral of the story is you can put your eggs in a lot of baskets and diversify, or put your eggs in a few baskets, but as Andrew Carnegie said, watch those baskets. Make sure you understand the risks you're taking and why. Outline your sell discipline, why you would sell certain securities. Make sure you're monitoring those, and use potentially hedging strategies to make sure your risks are in line with your goals. We don't want to blow ourselves up financially. It's just too costly to recover from. It could take years or decades. So sometimes the best option is to be okay with a little less performance because you're taking less risk. Move those assets aside and come up with good ways to make sure your family's protected and you have someone watching your back to look out for the landmines. If you'd like an advice-only approach from a licensed professional with over a decade and a half of experience in the industry as a financial advisor, give us a call. The first 30 minutes is free. We can cover a lot of ground to see if you qualify as a client, to see if we can add value, and if we can't, hopefully you're smarter in the end of it and you can come back to us if you ever need us, or maybe teach us a lesson or two.